Understanding market volatility. When investors talk about fear in the stock market, they often refer to something called the VIX index. But what exactly is it? Why is it sometimes called the fear gauge? And how does it affect investment decisions? Let's break it down. The VIX, or Volatility Index, is a real-time market index that represents the market's expectations for volatility over the next 30 days. It was introduced by the Chicago Board Options Exchange in 1993. The VIX doesn't predict market direction. Instead, it measures how much the market thinks the S&P 500 will move, up or down, in the near future, based on the prices of S&P 500 index options. A high VIX value suggests that traders are expecting big market swings, often tied to uncertainty, economic news, or global events. A low VIX implies calmer markets and lower perceived risk. For example, during financial crises like the 2008 crash or COVID-19 in 2020, the VIX spiked dramatically, showing a surge in investor fear and market uncertainty. But in stable economic periods, the VIX tends to stay low, usually under 20. Here's a quick look at how the VIX behaves. Under 15 means calm, stable markets. Between 15 and 25 indicates mild volatility, and over 30 suggests heightened fear or uncertainty. These aren't hard rules, but general reference points used by analysts. So, why should we care about the VIX? Because it helps investors understand market sentiment, is used by fund managers to hedge portfolios, and can signal potential market turning points. But keep in mind, the VIX is not a crystal ball. It doesn't say whether the market will go up or down, only that it's likely to move a lot based on what traders are pricing in. To summarize, the VIX index tracks expected market volatility based on S&P 500 options. It's often called the fear index, but it simply reflects uncertainty, not direction. A higher VIX means more expected volatility, often due to fear, news, or speculation. Investors use it as a risk management tool, a sentiment indicator, and for strategy building. Understanding the VIX helps you grasp how markets perceive risk, a crucial insight for smarter investing and economic awareness. Thanks for watching. Keep learning and stay informed. Know the VIX, know the volatility. Professor Rahul Jain, for educational purposes only. No financial advice intended.